The evolution of Agnico Eagle Mines into the premier high-margin gold producer in the global mining industry is an artifact of decades of regional consolidation and a focused commitment to the Abitibi Greenstone Belt. Following the merger with Kirkland Lake Gold in 2022, the company has successfully architected a portfolio that prioritizes operational stability in low-risk jurisdictions, specifically Canada, Australia, and Finland. This strategic geographic concentration serves as the primary driver for growth, as it minimizes the political risk discount typically applied to mining equities while maximizing logistical and technical synergies across adjacent operations. The fiscal performance observed throughout 2025, culminating in record-breaking results in the third quarter, reveals a company that has effectively translated higher realized gold prices into robust free cash flow and a fortified balance sheet.
Operational Review. Abitibi Greenstone Belt of Quebec and Ontario is the primary source of Agnico's low-risk production profile. This region, known for its deep-seated geological stability and favorable mining laws, accounts for the vast majority of the company's reserves and output. The Canadian Malartic Complex and the Odyssey Underground Project. The Canadian Malartic Complex, located in northwestern Quebec, is one of the world's largest gold mining operations. While open-pit mining at the Canadian Malartic Pit concluded in 2023, the Barnat Pit continues to provide ore and is expected to operate through 2029. The future of the complex, however, is the Odyssey Mine, which is set to become Canada's largest underground gold operation. The transition to underground mining at Odyssey is progressing on schedule. By the third quarter of 2025, conventional shaft sinking resumed following the completion of critical loading stations. The Odyssey Mine is expected to produce approximately 8.5 million ounces of gold over its life through 2042.
A key strategic driver at Malartic is the Fill the Mill initiative, which aims to utilize the 40,000 tons per day of excess mill capacity that will become available starting in 2028. This capacity will be filled by regional satellite deposits, such as the Marban deposit, which is expected to contribute 130,000 ounces of gold annually starting in 2033. Exploration at Odyssey continues to yield results, particularly at the East Goldie deposit. Recent drilling in the upper eastern extension of East Goldie returned intercepts of 4.8 grams per ton gold over 25.4 meters, potentially identifying a second mining area. The Odyssey Mine now hosts approximately 5.55 million ounces of gold in proven and probable reserves, with an additional 9.7 million ounces in the inferred category, providing a long-term production runway. Detour Lake, scaling toward 1 million ounces. The Detour Lake Mine in Ontario is another cornerstone asset. In the fourth quarter of 2024, the mill achieved a record throughput of 77,000 tons per day, with plans to increase this to 79,450 tons per day by 2028. However, the most significant growth driver at Detour Lake is the proposed underground mining project. Agnico Eagle is currently developing an exploration ramp at Detour Lake, which advanced 259 meters by the third quarter of 2025. This underground project targets a high-grade core of mineralization beneath the existing open pit, with the potential to increase total annual production at Detour Lake to approximately 1 million ounces starting in 2030. The 2024 preliminary economic assessment for the underground project highlights a subset of mineral resources grading 1.93 grams per ton to 2.36 grams per ton gold, significantly higher than the current open pit reserves. This transition to a concurrent open pit and underground operation is expected to extend the mine life to 2054.
Macassa and LaRonde. The Macassa Mine in Ontario and the LaRonde Complex in Quebec remain vital high-grade producers within the Abitibi platform. Macassa is one of the highest-grade gold mines in the world, and Agnico Eagle has focused on optimizing its operations through the integration of the fourth shaft and exploration of near-surface targets like the Amalgamated Kirkland AK zone. LaRonde, Agnico Eagle's flagship asset for decades, continues to deliver strong production, led by its ability to extract gold from depths exceeding 3 kilometers. In the third quarter of 2025,
LaRonde and Meadowbank were the primary drivers of the company's record operational results. The complex also benefits from significant byproduct credits in silver, zinc, and copper, which help to lower the net production costs per ounce of gold. Nunavut operations, the Arctic advantage. Agnico Eagle's Nunavut platform, consisting of the Meliadine and Meadowbank complexes, provides a critical geographic diversification within Canada. Despite the logistical complexities of operating in the Arctic, the company has established a robust infrastructure and a skilled local workforce that have turned these assets into reliable cash flow engines. Meliadine and Meadowbank performance. Meliadine continues to benefit from its 2024 processing plant expansion, which is expected to increase mill capacity to 6,250 tons per day in 2025. The Meadowbank complex, specifically the Amaruq satellite mine, has demonstrated consistent production and cost performance throughout 2025, contributing significantly to the company's ability to meet its full-year guidance.
Hope Bay Exploration and Development. The Hope Bay project represents the next major growth leg for the Nunavut platform. Since acquiring the project, Agnico Eagle has focused on aggressive exploration to expand the mineral resource base. In 2025, the company conducted a 68,800-meter drill program through the first half of the year, focusing on the Doris and Madrid deposits. Results from the Patch 7 zone at Madrid have been particularly encouraging, with high-grade intercepts such as 25.7 grams per ton gold over 8.4 meters. These results suggest that Hope Bay has the potential to become a multi-decade producer, with a larger-scale development scenario currently under evaluation. International operations, Finland and Australia. While the core of Agnico Eagle's value lies in Canada, its international assets in Finland and Australia provide exposure to other stable jurisdictions and geological environments. Kittila, Europe's largest gold producer. The Kittila mine in Finland is the largest primary gold producer in Europe. Agnico Eagle has invested heavily in Kittila's infrastructure, including a recently completed shaft sinking project that has improved operational efficiency and reduced energy costs. Exploration at Kittila is focused on resource conversion and extending the mine life, with the asset continuing to be a steady contributor to the firm's northern business segment. Fosterville, navigating reserve depletion and expansion. The Fosterville mine in Victoria, Australia, has historically been one of Agnico Eagle's most profitable assets due to its extremely high grades. However, the mine has faced a declining grade profile as high-grade zones are depleted. To address this, the company secured approval for the Sustained Operations Project in May 2025, which allows for the continuation of mining for at least the next 10 years.
Agnico Eagle is reinvesting significantly in Fosterville, focusing on automation, AI-driven geological modeling, and the exploration of new areas such as Robbins Hill and Signet. In 2024, the mine successfully replaced 86% of its production with new mineral reserves, and the approval of the Sustained Operations Project provides the regulatory certainty needed to continue exploration in this highly prospective district. For 2026, the mine strategy integrates real-time ore sensor technology and advanced underground robotics to maintain competitive costs as it transitions to a more conventional grade profile. Exploration pipeline and the future of critical minerals. Agnico Eagle maintains an exploration program with a budget of approximately $300 million for 2025. The company's focus remains on extending the life of existing mines and advancing a robust pipeline of development projects, including Upper Beaver, Wasamac, and San Nicolas. Upper Beaver and the Kirkland Lake District. The Upper Beaver project in Ontario is a key future growth driver. As of year-end 2024, the company declared initial mineral reserves of 2.8 million ounces of gold at Upper Beaver. Shaft construction is set to begin in late 2025, with the project expected to become a significant contributor to the company's production in the late 2020s. The Avenir Unit, Critical Minerals Diversification. In late 2025, Agnico Eagle launched Avenir, a $130 million independent unit focused on evaluating and developing critical mineral opportunities outside of the company's core gold and copper operations. Primarily focused on Canada, Avenir represents a strategic move to leverage Agnico Eagle's technical and jurisdictional expertise in the rapidly growing critical mineral space.
Financial performance and valuation analysis. The valuation of Agnico Eagle Mines is fundamentally anchored in its ability to generate superior operating margins relative to its senior peers. During the third quarter of 2025, the company reported record revenues of $3.06 billion,
and adjusted net income of $1.085 billion. This performance was underpinned by a realized gold price of $3,476 per ounce, which represented a $20 per ounce premium over the average spot price for the period. The company's financial mechanics demonstrate a high degree of operating leverage, where the expansion in gold prices has significantly outpaced the inflationary pressures on production inputs. Quarterly and year-to-date financial trajectory. The growth in financial output from 2024 to 2025 highlights the company's increasing efficiency. The quarterly results for Q3 2025 compared to Q3 2024 show a substantial increase in all key areas. Revenue rose from $2,160 million to $3,060 million. Adjusted EBITDA increased from $1,257 million to $2,098 million. And net income grew from $567 million to $1,055 million. Operational cash flow for the quarter was $1,816 million, compared to $1,085 million in the prior year, while free cash flow reached $1,190 million, up from $620 million. Capital expenditures for the quarter were $644 million.
For the first 9 months of 2025, the trend remains similarly robust. Revenue, $8,840 million, compared to $6,320 million in the same period for 2024. Net income, $2,938 million, compared to $1,386 million in 2024. Cash from operations, $4,706 million, compared to $2,829 million in 2024. Free cash flow, $3,089 million, compared to $1,573 million in 2024. Capital expenditures, $1,601 million, compared to $1,265 million in 2024. The generation of $3.089 billion in free cash flow over the first 9 months of 2025 marks a pivotal shift in the company's capital flexibility. This volume of cash flow enabled the repayment of approximately $400 million in debt during the third quarter alone, reducing the outstanding principal on senior notes to less than $200 million. By the end of September 2025, Agnico Eagle transitioned into a significant net cash position of $2.159 billion, effectively eliminating traditional solvency risks and allowing the company to fund its extensive organic growth pipeline entirely from internal sources. Margin sensitivity and the royalty impact. A critical component of Agnico Eagle's valuation is the resilience of its margins. While total cash costs per ounce rose to $994 in Q3 2025, it is essential to distinguish between operational inflation and price-driven cost increases. Royalties, which are directly tied to the realized price of gold, added approximately $61 per ounce to the cost profile in the third quarter when compared to initial guidance assumptions. The operational cost efficiency is better understood by normalizing for these royalty effects. If gold prices had remained at guidance assumptions, the Q3 cash costs would have been approximately $933 per ounce. This indicates that the company's internal cost management remains disciplined, with the year-to-date average cash cost of $943 per ounce sitting comfortably within the established guidance range. The operating margin, calculated as the difference between the realized gold price and the all-in sustaining cost, AISC, reached approximately $2,103 per ounce in the most recent quarter, showcasing the company's superior profitability at current spot levels.
Valuation methodology and comparative multiples. Agnico Eagle Mines has historically traded at a valuation premium relative to senior gold producers such as Newmont Corporation and Barrick Gold. This premium is a reflection of the company's lower geopolitical risk profile and its consistent track record of operational execution. Historical and current valuation multiples. As of early 2026, the company's valuation multiples reflect both the recent share price appreciation and the significant growth in earnings. Current valuation metrics compared to 5-year averages and peer medians are detailed as follows. Price to earnings, PE, currently trades at 24.8x, which is lower than the 5-year average of 28.4x, but higher than the peer median of 18.2x. EV/EBITDA.
The current multiple is 11.9x, compared to a 5-year average of 10.1x and a peer median of 8.8x. Price to book, PB, currently 1.88x versus a 5-year average of 2.10x and a peer median of 1.45x. Forward PE ratio, trading at 17.6x compared to a 5-year average of 21.2x and a peer median of 13.0x. Price to FCF, currently 18.4x compared to a 5-year average of 22.5x and a peer median of 15.6x.
Net asset value, NAV, and operational leverage. The valuation is further supported by a robust mineral reserve base of 54.3 million ounces of gold. The price to net asset value, P/NAV ratio, remains a core focus for institutional investors, as it measures the market's willingness to pay for the future production potential of the company's reserves. Agnico Eagle's high reserve grades, specifically the 12.3 grams per ton at Eagle River and the high-grade cores at Macassa and Fosterville, provide a significant buffer against potential declines in gold prices. The company's return on invested capital, ROIC, provides a quantitative measure of the quality of its management and assets. In 2025, AEM reported an ROIC of 12.78%.
Capital allocation and shareholder value. The company's capital allocation policy is designed to balance internal growth requirements with the return of capital to shareholders. With the transition to a net cash position of $2.2 billion in Q3 2025, the focus has shifted toward opportunistic share buybacks and potential dividend increases. For 2026, analysts forecast that Agnico Eagle could generate approximately $5.04 billion in free cash flow, providing substantial room for increased returns. Dividend policy and share repurchases. Agnico Eagle has an unbroken record of paying dividends since 1983. The current quarterly dividend of 40 cents per share represents a conservative payout ratio of approximately 27%, which is well supported by free cash flow. In the third quarter of 2025, the company returned $350 million to shareholders through dividends and repurchases. Shareholder return metrics illustrate this commitment. Cumulative dividends paid, $792 million in full year 2024 and approximately $600 million for the first 9 months of 2025. Share repurchases, $400 million in 2024 and approximately $300 million for the first 9 months of 2025. FCF payout ratio, approximately 55% in 2024, decreasing to roughly 29% for the first 9 months of 2025 as total cash flow generation surged.
Sensitivity analysis. Valuation at different price points. The inherent volatility of gold requires a sensitivity analysis to understand the company's valuation under various price scenarios. At the current spot gold price, approximately $3,500 per ounce, Agnico Eagle is operating at peak efficiency with an annual EBITDA run rate of approximately $8 billion. This level of earnings makes it the third largest company in Canada by EBITDA. The company captures the full upside of price rallies through its unhedged production profile. For every $100 per ounce change in the price of gold, Agnico Eagle's annual EBITDA is estimated to shift by approximately $340 million, assuming a stable production base of 3.4 million ounces.
Balance sheet analysis. The evolution of Agnico Eagle's balance sheet throughout 2025 has moved the company from a position of relative leverage to having the strongest financial in the industry. As of September 30, 2025, the company officially transitioned to a net cash position of $2.16 billion. This transition was accelerated by the repayment of $400 million in long-term debt in Q3 2025. Key financial health metrics as of late 2025 include liquidity. Total cash and short-term investments reached approximately $2.4 billion. Leverage. The company's debt-to-equity ratio has plummeted to 0.8%. Solvency. A current ratio of approximately 2.1x to 2.12x indicates a robust ability to cover short-term liabilities entirely through liquid assets. Asset base. Total assets are valued at approximately $32.7 billion against total liabilities of only $9.2 billion, resulting in a total shareholder equity of approximately $23.5 billion. This balance sheet strength was institutionalized in August 2025, when Moody's Investor Service upgraded the company's long-term issuer rating to A3 from Baa1. This upgrade lowers the cost of future capital and provides the firm with immense strategic flexibility to pursue opportunistic M&A or accelerate project timelines without diluting existing shareholders.
Conclusion: Agnico Eagle Mines' valuation is not merely a product of the current gold price, but is built upon a foundation of multi-decade asset lives and a safe jurisdictional profile. The integration of the Kirkland Lake assets has provided the company with the scale and high-grade production necessary to perform throughout the commodity cycle. The company's strategic shift to a net cash position in 2025 is a fundamental de-risking event that has yet to be fully reflected in historical valuation multiples. With the Detour underground project and the Odyssey mine set to drive production and free cash flow growth through 2030 and beyond, the combination of a conservative capital allocation policy and an industry-leading ROIC suggests that Agnico Eagle is positioned to sustain its premium valuation. Agnico Eagle's stable and high-margin exposure to gold is likely to drive continued growth for the company if gold prices remain elevated.